Hi traders, Joseph here from EightCap. Today's video we're going to look at divergence. So divergence is when price and normally a momentum indicator are moving in opposite directions to each other, and this divergence can be used as a qualifying system to basically show that price may be about to turn direction or continue in the direction that's currently traveling in. So a lot of traders will look at divergence as a prelude to a possible price movement, but what I do want to really stress to you before we get into examples, as they will look pretty perfect and you'll be thinking, oh, this might be the change to my trading I'm really looking for. I do really err on caution, as divergences are fantastic, especially in ranging markets. They can be highly accurate, but in fast trending markets, they can cause you a lot of grief, especially regular divergence, which we'll touch on in a moment. So you're basically picking highs or lows, and in very fast moving markets you'll get divergent signals, but markets will keep either making higher highs or making lower lows. So the basic message I'm really trying to communicate here is that they're great as a leading pattern or a signal pattern, but then you'd want to use further confirmation after that, just to try and make sure you don't get caught by any false signals. So I've got the three main indicators that people mainly use for finding divergence. One is the CCI, which is Commodity Channel Index. The second is the MACD, which is a moving average cognitive divergence. And third is one of the most popular momentum indicators, is a relative strength index. So we'll have a look at the chart and we'll just have a look at a couple examples of regular and then hidden divergence. So regular divergence is when, say an example here, that the market's made a new low at this point, and you're looking at the CCI, MACD, or the RSI below, and you'll see that it's made a low here, which is going to be higher, and then the market's gone up, gone down, made a new lower low, but these indicators have made a higher high. So you can see where we're measuring from this low to this low, the indicator has gone higher, but price, we can see, has gone lower. So I'll just draw that in so it's quite visible. And you can see higher and lower. And then we can see here, amazingly, the market made this amazing rally higher. Again, I state that I'm not trying to sell this as some sort of holy grail, because I've spent personally a lot of time trading with divergence, and while it is fantastic, it can also set you up for certain issues. And a good example of that actually is right here in front of us. We can see that the market here made a slight lower high from this point to this point, and you can see the market made a higher high to this point. It did decline, but then we had another extension higher. So if you'd sold at this point, it wouldn't have been a very long position. You would have been cut out very quickly. So that's an example of where it can put you into trouble when you're trying to just use divergence solely on its own. So we will just have another look at the top of this market. We can see another reasonable example. I'm just going to get rid of the MACD. So we can see at the top of this market that we're measuring from this point to this point here, which is the high. We can see that we had a lower highs on the CCI, and we can see on the chart that we had higher highs on the price, and then we led to a decline. So that divergence was a winner at that particular time. And Again, they do look great, I know. Sometimes they look really perfect, but I do stress that if you just trade on divergence alone, potentially you're going to run into issues. So what we'll look now is at an example of what's called hidden divergence, where opposite to regular divergence, instead of moving inwards to each other, the divergence were moving away from each other. So we can see here at this point that the CCI indicator and the RSI, it moved higher, but price at this point moved lower. So that is an example of hidden divergence, and a lot of people trade it as a trend continuation setup. So we can see at this point that the trend continued lower in the current downtrend. And we'll just put that onto the... See, the RSI, it doesn't make as good a standout patterns normally as the CCI. So that's why a lot of people prefer to use the CCI. But you can see it was there, and it was there on the price. So that there, traders, is an example of hidden divergence as a trend continuation pattern, and this here is a example of regular divergence, which normally preludes to a change in trend. So hidden divergence is normally a trend continuation, regular divergence is normally a prelude to a change in trend. So again, it's best to have another confirmation tool after you see divergence. It's great to be used as a pattern, but again, I just want to stress this as many times as possible. It can run into issues when just being used on its own, so it's best to be looking at it as a pattern and then looking for a confirmation after you've given it credibility and it's proved itself. So I hope that was helpful, and I hope it all made sense. If you have any further questions, feel free to get in contact with us, and wish you all the best for the trading week. Bye for now.